Welcome to Central Bank Central. I'm Kathleen Hayes here in Philadelphia at the annual meeting of the AEA, the American Economics Association, and a special guest, one of the stars of the shows and the panels the last few days, and that's Loretta Mester. She's former president of the Federal Reserve Bank of Cleveland. And in fact, Loretta, you were on a couple of panels, one looking at the future of the Fed, big picture, lots of issues raised, and the other about data, government statistics, and of course, we are in this week going to get a big statistic at the end of the week. That's a jobs report on Friday, and of course the Fed's meeting at the end of the month, and there's still some questions about what they will or won't do, but certainly a question about data, certainly a question about the jobs report. But let's start there. In terms of what the jobs data look like to you in the sense of reliability. Are they going to give us an accurate reading? Is it enough for that? The Fed's been cutting rates on some pretty uncertain data in terms of how realistic or accurate it is. I guess that's the word I'm looking at. So what do you think from that side of the jobs report? What are you thinking?
Well, the Fed has to use the data that's available, but the Fed also knows that data are subject to revision. So again, they're going to take the jobs report, they're going to look at it and see whether it's telling them about payroll growth, about the unemployment rate, and all data are measured with some error, and they're going to take that into account when they're doing their policy making. I want to emphasize that one report should not be changing a Fed policymaker's view of the economy. The data informs them about sort of whether their view of the economy and how it's evolving is correct. So I think of the data as sort of a disciplining device on checking, whether the Fed policymakers' view is consistent with the data, making sure that the data disciplines any kind of judgment that they bring to bear in making policy. And it's looking at the payroll report along with a lot of other data that informs them about the current economy and also their forecast about where the economy is going that'll be important in determining what they'll do with interest rates.
Sounds very reasonable to me. At the same time, so much is riding on the labor market right now. Inflation is well above target. It's been above target for a long time. Fed shows, the only question is, are they going to cut again right now, or are they going to wait? No one's talking about rate hikes, of course. But with so much emphasis on jobs, and it seems to me that you hear in Fed speeches, people currently at the Fed, people who watch the Fed very closely, that seems to be a lot of the debate of what the Fed should do next. And again, also this is a time of, we've had the migration changes, immigration changes, we've had deportations, labor market is barely growing compared to what it used to do, right? And it just seems that it puts a big cloud over putting, to me, that much emphasis on the labor market.
Well, the Fed has a dual mandate. It's price stability, of course, and we've interpreted that as being 2% inflation and maximum employment. Now, so they have to be looking at both parts of that mandate whenever they're making a policy decision. Recently, right, as you say, inflation is still above 2%, and it's been above 2% for almost 5 years now, right? It's certainly, the inflation rate has come down from the peaks that we saw in the post-pandemic period, but it's still running above 2%. And my own view is that there isn't enough evidence that suggests that even if you take tariffs out, which I know the Fed has said that they're going to look through those tariff increase prices, that inflation X those tariffs is on its way down to 2%. So to my mind, I have to be putting a lot of, my concern on the inflation side of the mandate. But we also have to say that, right, we have seen softening in the labor market. What's tricky about it is that there's both demand side and supply side factors driving that softening, right? So certainly firms are not hiring as much as they were before. If you look at openings, they've been going down, and the firms are just trying to sort of preserve margins, I think, in the wake of those higher tariffs, and so they're going to be cautious about hiring. And then there's also some firms that are sort of putting a lot of weight on AI and other kinds of technological changes to help them limit, right, how many people they need to actually do their job. On the supply side, the immigration policy that you mentioned is important, right? So we've seen a strong decline in the rates of immigration, and that has limited the supply labor. So I like to say that the labor market's in this uneasy balance. We have firms not hiring as robustly, and certainly that's softening, but we also have fewer supplier workers. So the labor market's in a kind of uneasy balance. We have seen the unemployment rate tick up, and I think that's the focus of many Fed policymakers, is whether you'll see a more material increase in the unemployment rate and a more material softening in the labor market. I would still put the emphasis on the inflation part of the mandate. I think the labor market could basically be in this sort of stasis for a few months longer, but we'll have to see, and I think that's what the Fed will have to evaluate.
So how do you read the Fed, all 19 members, 12 Fed bank presidents, the other 7 on the Board of Governors? We've heard speeches, we've seen various, I guess that's the main thing. There's been a lot of people talking the last few weeks. And number one, I guess, would be, what's your sense? And it's been, one of the things one word that often goes with the Fed right now is divided. Very divided. You've got hardcore, let's keep cutting rates, or maybe not so hardcore as they were, and others that still say, hey, the inflation's still high, we're not really sure what this data means, we can go slow. How do you read that?
Right. Well, if I were still on the committee, I would be in the camp of let's wait and pause and see how the economy is going to evolve, because I am concerned that if they do continue to cut interest rates, they will quickly be at neutral and move beyond neutral. And if you really are serious, and I think the Fed is, about being committed to getting inflation back down to 2%, you're going to need to have policy somewhat restrictive in order to do that. So I think there's going to be, now that they've cut the 3 times, I think there are going to be more of the Fed policymakers saying, okay, now we've gotten policy calibrated, we have the opportunity to wait a bit more, see how the economy is evolving, see if the labor market is basically stabilizing or whether it's continuing to deteriorate, and have that inform our views. So again, I think you're right, there is difference of opinions on the weight between those 2 parts of the mandate. And my own view is it's healthy to see that kind of disagreement on the Fed, because it is an uncertain environment. It is an uncertain economy. We don't know exactly how the economy is going to evolve. And in those circumstances, I think it's good that we have people that aren't all looking at everything the same way.
For sure. Just quickly, any comment on how strong GDP has held up and how I was speaking to someone who's in one of the big Wall Street firms. I don't know if they've publicly been talking about the forecast like this, but 2.5% GDP next year. Why do you cut rates with GDP expected at 2.5%,
Well, it is kind of remarkable. If you think back to the beginning of last year, everyone was thinking that, wow, it's going to be a weak year. The tariffs are really going to have a bigger impact. We may not see much growth at all. Some, I think, forecasters were even saying that there's a high probability of the economy moving to recession. And boy, the U.S. economy once again showed its resiliency. It's always good never to count out the resiliency of the U.S. economy. The economy, once the statistics are published, looks like it was performing at or above trend last year, not certainly in recessionary. And I think there's good reason to think that there are some tailwinds that'll support growth next year. So, for example, you do have the businesses are going to have that full expensing of their investment. You have people are going to be, I think, a bit surprised at the size of their tax refunds that'll support consumer spending, because even though the tax cuts were last year, they didn't change the holding tables, and so that I think people will get that, and that'll be supportive of consumption. And I think firms are still going to invest in AI, the data centers, and the energy to support that movement in technology. So again, I think there's a good reason to think that the economy could get through a soft patch on the labor market if uncertainty reduces, and if the tariffs stay stable where they are. I think firms have done some of the adjustment, right? We probably will see further price increases, because firms have told us, right, that they, in their earnings reports and in other publications, that they're planning to do price increases to cover some of the tariffs that they haven't put in place yet. So we'll see that. But, if uncertainty kind of moves down, then we could easily see sort of a better economy next year, which I think generates perhaps some of the forecasts that you were citing in your question.
Well, and in terms of Fed credibility and inflation, I mean, first of all, do you feel like the inflation data are pretty accurate at this point? I mean, everyone's focused on the jobs report, but how do you feel about the inflation data? Everyone can forecast that it's going to come down. It really hasn't come down yet. Tariff is a question, but overall, do you feel that the readings at like 2.7 and then maybe 3.1 on the core CPI year over year is an accurate one, which shows that the Fed is definitely has cut rates, still thinking about it at a time like that? And what does that mean for Fed credibility and ultimately maybe even inflation expectations, that eventually that gets more baked into the cake?
Well, I think the Fed has got to be very cautious now. I mean, inflation has been above 2% for quite a long time now, 5 years. And you're right, so far, the median to long-run inflation expectations haven't shown movement. They're in the ranges that are still consistent with 2%. Well, we have seen movement in the short-run inflation expectations, so I don't think we should count out that the Fed is going to have to get inflation back down to 2% to preserve credibility, and that means it's going to take somewhat restrictive monetary policy to do it. We're in an environment now where it could be that the technological changes that firms put in place to address the labor shortages during COVID and after COVID, plus the AI technological changes, mean that productivity will be sustained at a higher level than it has been for many years. And that means that the equilibrium rate of interest in the economy, that neutral rate of interest, is higher than it's been. Two things about that. If productivity is higher, the economy can grow faster without generating inflation. But at the same time, the interest rate, that means the demarcation between easy monetary policy and restrictive monetary policy has moved up, which means the Fed has less room to cut rates to get to neutral. So again, the Fed has to be very cautious about continuing to do rate cuts in an environment where R star, that equilibrium interest rate, may be higher than it was. And so I think the Fed's going to want to collect some more information about the evolution of the economy before it wants to cut again.
This is just one part of the inflation picture. But of course, since Venezuela just had its president arrested, and oil traders love it. Everybody says there's going to be all this oil now that's going to be somehow under the U.S. control. There's going to be more oil available to the world, even if it's not always the best. The crude from Venezuela is what everybody needs, et cetera, et cetera. But when it comes to the Federal Reserve, obviously their geopolitical things like that are never going to affect their policymaking. But I wonder what would lower oil prices mean for the Fed at this point?
Well, I mean, it depends on whether that's sustainable or not, right? So I think the Fed is not going to be moving or deciding policy based on a short-run movement in oil prices. But eventually, if oil prices do stay lower and the projection is, forecasts are that it's going to stay lower, that's going to feed into the Fed forecast for inflation, right? And probably for growth as well. So again, I think it's too soon to say, whether that's market movements in oil prices are sustainable or not. The Fed has time to evaluate. It has time to see. It's a similar kind of question that we often get at the Fed about, if the stock market goes up, how does the Fed react to that? The Fed takes that into account when it thinks about overall financial conditions and whether they're easy or not easy when it pertains to monetary policy. There's also financial stability issues, but for monetary policy purposes, it's really about overall financial conditions, not about one particular price.
Well, let's get into some of the topics from the Future of the Fed panel that you were on. And again, looking out. But I think I want to start with uncertainty. Because when you spoke on that panel, that was one of the issues you were talking about as part of what the Fed has to deal with as it moves forward. And we haven't even talked about a new Fed chair. But no matter who takes over, and no matter what they want, there are still going to be big issues in front of the Fed, and this is the time to address them. So uncertainty, what does that mean, and what do you want to tell people about why the Fed has to address it and what it means for the Fed?
Yeah, I mean, I think the Fed really needs to embrace the fact that it operates in an environment of uncertainty. And I don't think that's anything that they should be afraid of in some sense. They shouldn't shrink from the uncertainty. They should be saying, look, we're not prescient as a policymaker, but we're going to behave in a systematic way, right? When the data come in and tell us, this is how the economy is evolving, we're going to react in a systematic way. It could be that the data come in and tell us that things are not evolving the way we expected. We're going to have to incorporate that into the way we do policy making. That means doing more with scenarios, right? Right now, the Fed is very focused on giving one central view of how the economy is going to evolve, which they have to do. But then they should also be communicating in terms of, but if the economy evolves in this alternative way, which is also plausible, then we're going to react this way. Or if the economy, ends up being that inflation does move down faster than we expected, we'll react with policy in a different way. And I think that would be a good way to communicate.
A very specific example of that then would be, okay, we know we're past the government shutdown, jobs data look strong, that the Fed should maybe even put, if they were going to give scenarios, would that be kind of the thing, here's what we're watching. Well, one thing we're watching, the labor market. The data have been constrained. We're going to watch that closely. And that's something that if it comes in, strong one way or another, more dramatically, that could change our path. Is that the kind of thing they'd be putting on the table?
Yeah, I think that's a good way to think about it. I think the relevant scenarios would be ones that are helping to exposit sort of the difference of views across the members, right? There are going to be some that think that labor market is going to be stronger going forward than others, right? Perhaps your view is that as the economy picks back up, as uncertainty around tariffs goes down, that firms will be willing to hire more, and therefore we'll see that strengthening. That would be one scenario. And that would perhaps mean a different policy path than the central tendency, which may see more softening in the labor market, at least over the first half of this year.
So in terms of, would that also mean that it'd be very clear, everyone would be told very clearly, I guess we get the SEPs, we get the Summary of Economic Projections, and then you see what people's, the consensus view is of GDP, inflation, unemployment, and then you see, very more specific numbers without their names attached. Is that also what would have to be, for example, the board staff at the Board of Governors, they have a consensus forecast. Now, I wish they would put the Fed Bank's economists averaging that into that too, right? But even that was a contentious issue when it was raised, and Ben Bernanke proposed something like this, right? Having a one view that comes from the board economists, and then that would be the starting point, and have scenarios. A lot of people at that conference pushed back.
Yeah, I mean, I think that under Ben, right? Ben tried to get, when he was chair, a consensus forecast of the committee, right? Mm-hmm. Not the staff forecast, because they have their forecast, but this would be of the committee. And it proved to be kind of complicated to get the committee.
Sure.
But I think this might be the right time to try to bring that back, because other central banks have forecasts. Some are the forecasts of the staff that they publish. Others are the forecasts of the committee. And I think that would be worthwhile, because that would give a coherent view of how is the committee seeing the most likely scenario for the economy, the central forecast, and then what are these alternative scenarios that they think are relatively important in helping formulate their views. The Bank of England in November's monetary policy report, they started articulating scenarios. Of course, it was interesting that Ben Bernanke was asked to do the review of the Bank of England, and one of his suggestions was scenarios. And I think it was successful. I mean, I know there's some that think that it could be improved, but I think if you read their monetary policy report, you'll see that they explain the central tendency, and then they say, but there's an alternative forecast, right, where inflation is more persistent. There's an alternative forecast where, the labor market is weaker, and those helped kind of articulate the risk around that central tendency in a way that is a coherent narrative about, okay, if these things evolve this way, policy may have to be different than our central tendency that we think policy is going to have to do. And I think that would be actually a way of building credibility with the public, because the public shouldn't hold a central bank accountable for being prescient about how everything is going to work, but they should hold them accountable for reacting in a systematic way should the economy evolve in different ways. And those scenarios give the central bank a way of explaining sort of how they're seeing the economy and alternative views, so that if policy does change, the public doesn't think, oh, you promised me it was going to do this and it did this. It's not that. You're not promising a policy path. What you are trying to do is being very consistent in your reaction function.
Right. Well, so in terms of some of the issues around the Fed, looking ahead, future of the Fed, and of course, new Fed chair coming in, I want to ask you about a couple specific things about the criticisms of the Fed, right? And mission creep. Are you trying to do too much? What you can control with monetary policy is inflation. Secondarily, you can try to make sure you don't get too tight, that you have a policy that is going to also keep an eye on the labor market. But the Fed, I've asked this question on the record, off the record with people. A lot of people just, but we already have enough potential criticism of ourselves, right? We don't want to put it out there in front of everybody else. But I want to bring up something, because Charles Plosser, who you worked for at the Philadelphia Fed, you started there, you became the director of research, you worked with him for many, many years, and then went on to the Cleveland Fed. But he made this, I didn't bring the exact quote, but he said, you have to be ready for criticism, basically. You have to be ready to do that. What do you remember from him on that, and what does it tell us about what the Fed should be thinking and doing now?
Well, I think Charles was very articulate about accountability, right? And the Fed officials are not elected officials, and the Fed has to hold itself accountable for its policy. I think the Fed tries to do that, and part of it is going before Congress. The chair goes before Congress at least twice a year, publishing the monetary policy report, where he tries to explain the policy decisions and opens himself up to questions from Congress. The press conferences, the transparency has increased over the years in a way that I think is very helpful for accountability. That said, can the Fed do better? Yes. And one of the things I think they could do is every year do a report on how did we do. Right? How did we do? I think the framework review, the fact that they made changes to the strategy, indicates that they did do an internal review of, right, how did policy work during the pandemic and the post-pandemic period where inflation got up to 40-year highs. I know they did a post-mortem on that. I think that would be actually helpful for their credibility if they were the ones to release that, rather than waiting for others to criticize, right? I think you have to be self-reflective, right, and evaluate your own performance and own it, right, and hold yourself accountable. And I think Charles, would agree with that. There are things that the Fed could be doing, right, to hold itself accountable rather than allowing for others to do that for them. And I think that is probably the best way to preserve the independence of monetary policy from short-run political considerations. If you make policy focused on your dual mandate that Congress has given you, right, maximum employment, price stability, and then, right, evaluate your performance on achieving those goals and doing that yourself, I think that kind of accountability helps to preserve your independence from short-run political considerations.
Another big topic on the panel that you had on Future of the Fed had to do with fiscal dominance. And of course, fiscal dominance is a time when the fiscal side of it, the spending money, increasing the budget deficit, et cetera, is so big that monetary policy has to kind of swerve from its goals to and such as cutting rates to reduce interest cost burden of the debt. If you have high inflation, you might not want to do that. Are we there yet? Are you concerned about how that might take over?
Well, we're not in fiscal dominance yet. I think the Fed is focused on its dual mandate goals. It's able to bring inflation down using its policy tools. And we've seen inflation come down, right? What we were talking about earlier is the fact that it's not back down to 2% yet. But we have to give credit to the fact that inflation has moved down, and the Fed has been having a restrictive policy, at least up to this point, that's helped to bring inflation back down. But I think there are concerns with the fiscal sustainability of our fiscal situation and the possibility that we're moving into dangerous territory on that side of things. And that could lead to a place where monetary policy isn't able just to focus on its dual mandate goals, right? It's not a question of will, it's just will the fiscal side of the house allow monetary policy, right, to achieve, right, price stability. And so if the fiscal side of the house doesn't get itself in order, right, in a more sustainable position, right, with deficits being, not continuing to move up, especially when, right, we're not in a recession, we're not in a financial crisis, that's going to be a problem.
Janet Yellen, former Fed chair, said that she was pretty specific and kind of dark, kind of stark in her forecast. She thinks that that in order to get this done, bring down the deficit, even start doing that, it needs a bipartisan solution that she said doesn't look like it can be struck. Republicans and Democrats just can't even begin to talk about that. And she said ultimately she thinks some kind of market event, some markets getting upset by this, would force policy change or maybe, draining Medicaid or Social Security trust funds. But again, it's like, well, she really doesn't see anything happening until there's a problem, something that kind of blows up, and that's what happens.
Well, there have been solutions proposed in the past that are bipartisan. So, I don't want to give up all hope for that because we've seen it. And if you look at the Penn-Wharton budget model, which is a great resource, if people haven't looked at it, they should, right? They sort of lay out sort of some principles, right, that should be followed when you're doing this kind of budget appropriations, and then actually put out proposals of how you could get there. So it's not doable, right? It's just, will we agree on doing it, and will we get that kind of catalyst to get sort of the agreements that need to go through Congress and the administration? And I think that's what Chair Yellen was talking about is, it doesn't look like we have a Congress and administration that can work together to get there. And typically what you have seen is that it's when there's instability in the financial markets, or if some event in the financial market, that is the catalyst of that kind of change. And so, I'm sort of don't want to rule out that we can't get there, but I do think that might have to be the catalyst, which is unfortunate because we have it within our will and power to do it. We just don't have the will to do it.
Well, of course, besides being a monetary policy expert and a macroeconomist, you have a lot of background in financial stability. Another question I want to ask you about is financial regulation. But what are the signs you'd be looking for to say, it looks like things are crumbling around the edges, that the pressure has gotten enough that are we going to be watching Treasury bonds or the dollar, or would it be watching to say there's more of a little red flag starting to wave?
I look at both of those, right? Because we saw a little bit of that early in the year, last year, in the middle of the year, when you saw sort of risk premiums and term premiums on the bond market moving up, right? You saw even central banks moving some of their assets out of dollar-denominated assets into gold.
Wish
right?
I'd gotten in.
Yeah, well, and so that's the kind of thing you would see is when the public and the markets get skeptical, right, that the fiscal situation in the U.S. is sustainable, right? You're going to see that kind of action in both the bond market and in the dollar exchange rate. And so that would be where I would be looking to see if we have an issue. I don't think we were there yet. And the markets are surprisingly, in some sense, sanguine about it. But I think, these are one of these things that could change very quickly. And so that's where I'd be looking.
Financial regulation, it seems to me that even the person, the vice chair for supervision, Mickey Bowman, is talking about, and seeming to agree with Trump and his team, that there's too much bank regulation, you got to bring it down. That's one of your big areas of expertise. You've written about this. You're widely acknowledged as someone who understands this very well. So what do you see there?
Well, there's no doubt that the regulatory system has gotten very complex. And I think one of the things that Vice Chair Bowman is trying to do is trying to simplify it in a way that makes it less complex and doesn't overburden the smaller institutions that pose less financial risk, right? And making sure that the regulations that do apply to the large banks actually have the effect of helping them manage the risk and helping us manage the risk of the financial system. So I think the aim is probably well-founded, right? Let's try to make it less, complicated and simplify it and more coherent, right, with fewer redundancies. That said, I think we have to be cautious about deregulating in a way that makes the financial system less stable. And if we reduce, for example, capital requirements too much, we lose sort of the benefits that happened after Dodd-Frank of increasing, right, the stability. And one of the things that I like to point out is that the banks were in a very strong position going into COVID, which allowed, right, the Fed to sort of temporarily relax some of the restrictions so that they could support the economy. You want to be able to have a banking system that's healthy, right, in normal times so that it can help the economy through, right, less normal times, right, when the economy really needs the help from the banking system. So again, right, it's to everyone's benefit to have that stability. And if they deregulate too much, right, and the rhetoric from the administration is not realizing the benefits that you get from the regulation, then I worry about that. The other thing we have to acknowledge is that a lot of the financial system is not in banks anymore.
Right.
And so the non-bank financial system, right, non-bank financial institutions really need to be thought about in a new way in terms of their regulatory structure. And I think that would be something that I'm sure Governor Bowman Mickey's thinking about in terms of her role in sort of leading that kind of effort.
Quick final question. Looking ahead to the appointment of the next Fed chair, what are you hoping for? What are you fearing? I don't know. You can't probably, as a former Fed bank president, say who you'd be voting for or suggest to the president if it were you.
Well, I think like what I hope the new chair will be is someone who understands the importance of the Fed making policy decisions focused on dual mandate goals, price stability, maximum employment, based on the best economic expertise, modeling, data collection, data interpretation, right? And really not allowing external things to influence it. So that's one thing I think it's important, really sustain that independent monetary policymaking capability. The other thing is listening, right? Not coming in with like a zealot kind of viewpoint, there's only one way, but to listen to their colleagues around that table who have very different views on the economy, who have different ways of weighting, right, the risk around the economy. And, many times when I was at the table, I learned a lot from my colleagues by listening to what their viewpoints are. And so I think that's what you need in a chair, is someone who's willing to sort of be a leader, be independent, listen, adapt, update, and then lay out the right path for the committee as a whole. All right.
Loretta Mester, thank you so very much. Been a busy couple of days for you, and I'm so glad you could join us.
Thank you.
Former president of the Federal Reserve Bank of Cleveland. You can find her on LinkedIn. You can find her on so many places. And tell me just one more time, the Penn-Wharton model. I'd like to kind of...
Penn-Wharton budget model.
Okay. And we can just go right to
there. It's
okay.
all out there.
All right. Thank you so much.
Thanks.
I'm Kathleen Hayes, and this is Central Bank Central.